In the quiet corridors of global finance, history is filled with pivotal moments that go unnoticed by the public, yet reshape the world. One such moment, shrouded in secrecy, was the creation of a powerful alliance designed to defend an entire economic order. This is the story of the London Gold Pool, a covert agreement between the world's most powerful central banks to control the price of gold and, with it, the fate of the global monetary system. It's a tale of ambition, secret pacts, and the inevitable clash between market forces and government control, a clash that would ultimately bring an end to an era and usher in the financial world we live in today. The story begins in the aftermath of World War II with the establishment of the Bretton Woods system. In 1944, delegates from 44 Allied nations gathered in New Hampshire to design a new global economic framework, one that would prevent the devastating currency wars and trade protectionism that had plagued the 1930s. At the heart of this new system was the U.S. dollar, which was declared the world's reserve currency. Its stability was guaranteed by a simple, powerful promise. The United States would redeem any dollars held by foreign central banks for gold, at a fixed rate of $35 per ounce. This arrangement anchored the global economy. For a time, it worked beautifully, fostering an era of unprecedented growth and stability known as the post-war economic boom. The U.S. dollar was considered as good as gold, a reliable foundation upon which international trade and finance could be built. But as the 1950s drew to a close, cracks began to appear in this golden foundation. The world was changing, and the promises made at Bretton Woods were becoming increasingly difficult to keep. The problem was a matter of simple arithmetic. The United States was spending more abroad than it was earning, running persistent balance of payments deficits. These deficits were driven by the costs of maintaining military bases around the world, funding the Marshall Plan to rebuild Europe, and later the escalating war in Vietnam. As a result, a flood of U.S. dollars began to accumulate in the vaults of foreign central banks, far exceeding the U.S. Treasury's own gold reserves stored at Fort Knox. This growing imbalance did not go unnoticed. Speculators and even some central banks began to doubt whether the U.S. could honor its commitment to redeem dollars for gold at $35 an ounce. The free market price of gold on exchanges like the one in London began to creep upwards, at one point briefly touching $40 an ounce. This was a direct challenge to the credibility of the U.S. dollar and the entire Bretton Woods system. If the market price of gold were to permanently break free from the official peg, confidence in the dollar would collapse, triggering a global financial crisis. In response to this looming threat, a secret meeting was convened in November 1961. Officials from the U.S. Federal Reserve and Treasury met with representatives from 7 major European central banks, those of the United Kingdom, West Germany, France, Italy, Belgium, the Netherlands, and Switzerland. Together, they formed a clandestine consortium known as the London Gold Pool. Their mission was clear and urgent: to intervene in the London gold market to keep the price of gold firmly anchored at or near $35 per ounce. The mechanism they devised was both simple and powerful. The 8-member banks created a collective pool of gold, with the United States contributing 50%, and the other 7 nations covering the remaining half. The Bank of England was appointed as the group's agent, tasked with covertly operating in the London market. When the market price of gold threatened to rise above the $35 peg, the Bank of England would sell gold from the pool to push the price back down. Conversely, if the price fell, it would buy gold to replenish their reserves. For several years, this secret intervention worked. The London Gold Pool successfully managed to suppress the price of gold, maintaining the illusion of stability. To the outside world, it appeared that the U.S. dollar's link to gold was secure. But behind the scenes, the pressure was relentlessly building. The fundamental problem, the ever-growing supply of dollars overseas, had not been solved. The gold pool was not a cure for the disease. It was merely a treatment for the symptoms. The tide began to turn in the mid-1960s, largely due to the actions of one country, France. Under President Charles de Gaulle, France grew increasingly skeptical of what it called America exorbitant privilege, the ability to print dollars at will to finance its deficits, effectively exporting its inflation to the rest of the world. De Gaulle saw the Bretton Woods system as a tool of American economic dominance and decided to challenge it directly. Starting in 1965, France began aggressively converting its vast holdings of U.S. dollars into gold, demanding that the U.S. Treasury make good on its promise. This policy, known as cashing out, put immense strain on America's already dwindling gold reserves. To make matters worse, France withdrew from the London Gold Pool in 1967, refusing to contribute any more of its own gold to defend a system it no longer believed in. The departure of a key member was a symbolic and practical blow, leaving the remaining members to shoulder an even greater burden. The breaking point arrived in late 1967 and early 1968. The devaluation of the British pound sterling sent shockwaves through the financial markets, triggering a massive wave of panic buying of gold. Speculators, investors, and even some central banks rushed to dump their dollars and pounds in exchange for the timeless security of physical gold. The demand was insatiable. The London Gold Pool was forced to sell unprecedented amounts of gold to hold the line at $35. During one frantic week in March 1968, the pool hemorrhaged billions of dollars worth of gold. The drain was unsustainable. The secret alliance, once a powerful tool of control, was now being bled dry by the very market forces it had sought to tame. On March 15, 1968, at the urgent request of U.S. officials, Queen Elizabeth II declared a bank holiday and the London gold market was shut down. The London Gold Pool was quietly and unceremoniously disbanded. The dam had finally broken. In the immediate aftermath, officials scrambled to construct a new makeshift solution. They created a two-tier gold system. The official price of $35 per ounce would remain for transactions between central banks, but the price of gold on the private market would be allowed to float freely. This was a tacit admission of defeat. It acknowledged that governments could no longer control the price of gold in the face of overwhelming market pressure. This two-tier system was destined to fail. It severed the last meaningful link between the official monetary world and the real world of supply and demand. Trust in the U.S. dollar, already severely damaged, continued to erode. Foreign central banks saw the writing on the wall and accelerated their efforts to convert their dollar reserves into gold before the window of opportunity closed for good. The final act came 3 years later. On August 15, 1971, President Richard Nixon appeared on national television and made a stunning announcement. He declared that the United States would no longer convert U.S. dollars into gold for foreign central banks. The gold window was closed, severing the last tie between the dollar and gold. With that single act, the Bretton Woods system, which had governed the global economy for over a quarter of a century, was dead. The collapse of the London Gold Pool and the subsequent end of the gold standard marked a profound turning point in modern economic history. The world shifted from a system based on a tangible asset to one based on pure fiat currency money backed by nothing more than faith in the governments that issue it. This transition unleashed decades of monetary experimentation, chronic inflation, and currency volatility. Freed from the golden fetters, central banks could now print money with far fewer constraints, enabling governments to finance massive deficits through monetary expansion rather than taxation. This new era of financialization saw the rise of complex derivatives, floating exchange rates, and a global economy increasingly reliant on debt and credit. The very nature of money had been fundamentally altered. The legacy of the London Gold Pool is a powerful lesson in the limits of control. It demonstrates that even the most powerful alliance of governments cannot indefinitely defy fundamental economic laws. The attempt to artificially fix the price of gold was, in essence, an attempt to deny reality, the reality of America's declining economic dominance and the inherent instability of a debt-based monetary system. Today, we live in the world that the failure of the gold pool created. Central banks continue to intervene in markets on a scale that would have been unimaginable in the 1960s, manipulating interest rates and asset prices through quantitative easing and other unconventional policies. The financial instability, asset bubbles, and persistent inflation that characterize our modern economy can all trace their roots back to this pivotal moment when the old order collapsed. The story of the London Gold Pool is more than just a forgotten chapter of financial history. It is a cautionary tale about the consequences of hubris and the inevitable failure of attempts to suppress market realities. It serves as a reminder that true stability cannot be manufactured through secret agreements or government decree. It must be earned through sound policy, fiscal discipline, and a currency that inspires genuine, lasting confidence. The echoes of its collapse continue to resonate through our financial system, shaping the challenges and uncertainties we face to this day.